But saving money is only half the equation. You can pinch pennies until Lincoln screams, but without investing, you are just watching your wealth slowly erode through the silent thief called inflation. The rules shift now. We move from defense to offense, from protecting what you have to growing what you will have. Benjamin Graham understood this better than anyone. In 1949, he published a book called The Intelligent Investor. It was not his first book. He had already written Security Analysis in 1934, a dense, technical tome that basically invented the profession of securities analysis. But The Intelligent Investor was different. It was written for actual humans, not just Wall Street professionals. A young man in Omaha read it at age 19 and later called it the best book on investing ever written. That young man was Warren Buffett. He still reads it today. The lessons in that book have not changed, and neither has the core message. The investor's chief problem, and even his worst enemy, is likely to be himself. Graham introduced a character that has become one of the most famous metaphors in finance. He called this character Mr. Market. Picture a business partner who shows up every day at your office door. Some days he is euphoric. He offers to buy your share of the business at outrageous prices, because he is convinced the future is bright. Other days, he is despondent. He offers to sell you his shares at bargain basement prices because he is certain everything is going to collapse. You, the intelligent investor, have a choice. You can accept his offers, or you can ignore them. You can let his mood swings dictate your actions, or you can calmly take advantage of them. Graham's point was that Mr. Market is there to serve you, not to guide you. When he offers you a price, he is not telling you what your investment is worth. He is telling you what he feels like paying or selling for in that moment. Your job is to know the difference. Most investors get this exactly backward. They see the stock market going up and they feel excited. They want in. They buy at the peak. Then the market crashes and they feel panicked. They sell at the bottom. They have turned Mr. Market's mood swings into their own mood swings. They have adopted his emotional state instead of exploiting it. This is how wealth transfers from the impatient to the patient. Buffett later refined Graham's idea into something even simpler. The stock market is a device for transferring money from the impatient to the patient. He was not being poetic. He was being literal. Here's something Wall Street does not want you to know. You can beat most professional investors by doing almost nothing. I am not exaggerating. The data proves it. Over any 20-year period in market history, a simple index fund that owns every stock in the market has beaten the vast majority of actively managed funds run by professionals who spend 60 hours a week analyzing companies. Why? Because those professionals charge fees, and those fees compound just like your returns do, except in the wrong direction. A fund that charges 1.5% in annual fees does not sound like much until you run the math. Over 30 years, that fee structure can consume over 30% of your total returns. The industry has built an entire ecosystem around convincing you that you need experts, that complexity equals competence, that paying more gets you more. It is a brilliant marketing campaign. It is also completely wrong. John Bogle founded Vanguard in 1975 with a radical idea: create a fund that owns every stock in the market, charges almost nothing in fees, and lets the market do what the market does. Wall Street laughed at him. They called it Bogle's folly. They said nobody would want to own a fund that just matches the market, when they could own funds that beat the market. They were wrong. Today, index funds hold trillions of dollars. Bogle's insight, which came partly from his Princeton senior thesis in 1951, was that professional investors as a group cannot beat the market because they are the market. Their fees and trading costs ensure that they will underperform. The math is brutal and unyielding. Index investing works because it accepts average returns in exchange for above-average results after costs. It is the closest thing to a free lunch in finance. Bogle spent the rest of his life trying to explain this to anyone who would listen. The financial industry spent the same period trying to obscure it. Both sides got what they wanted. The rule about time in the market versus timing the market follows directly from this. Vanguard analyzed investor behavior over several decades and found that the average investor significantly underperforms the market. Not because they picked bad stocks, but because they moved their money around trying to predict the future. They bought high and sold low over and over again, convinced each time that this was the moment to act. The market goes up about 10% a year on average over long periods, but that average hides tremendous volatility. Some years it goes up 20%, some years it drops 30%. The years it drops feel like financial death. The years it rises feel like you are a genius. Neither feeling is accurate. The market does not care about your feelings. It is a mechanism for processing information about the future profitability of businesses. Your job as an investor is to own pieces of good businesses and wait. That is it. You do not need to predict recessions. You do not need to forecast interest rates. You need to buy broad index funds and stay seated when the ride gets bumpy. The average holding period for a stock in 1960 was about 8 years. Today, it is about 5 months. We have become a society of hyperactive day traders pretending to be investors. We check our portfolios daily, sometimes hourly. We react to news that will be irrelevant in a week. We treat investing like gambling, when it is the opposite of gambling. Gambling is risking something on an uncertain outcome in the short term. Investing is owning something that produces value over the long term. The distinction matters because the outcomes are so different. The house always wins in gambling. In investing, the patient investor always wins. Not every stock, not every year, but over time, across a diversified portfolio, the math works in your favor. Diversification is what Graham called the only free lunch in investing. You can reduce your risk without reducing your expected returns by spreading your bets across many different assets. Own stocks, sure, but own many stocks across many sectors and many countries. Own some bonds, some real estate, maybe a little gold or other alternatives. The goal is not to maximize returns in any single year. The goal is to survive long enough for compounding to work its magic. Because here's the thing about compounding. It is boring for a very long time. And then it is absolutely extraordinary. Buffett is worth over $100 billion. But did you know that 99% of his wealth was accumulated after his 50th birthday? He started investing when he was 10 years old. He is now in his 90s. That is an 8-decade runway for compounding. The first $50 million took decades. The last $50 million happened almost automatically because the snowball had grown so large that it rolled downhill under its own momentum. You will not have 80 years, but you might have 40 or 50. The math works the same way, just with smaller numbers. Time is the secret ingredient. Not skill, not timing, not inside information, just time. Wall Street has a vested interest in making you believe that investing is complicated. Complicated things require experts. Experts charge fees. Fees generate revenue. Revenue buys yachts. You see the pattern. There is an entire industry built around convincing you that you cannot possibly manage your own money. That you need someone to tell you which funds to buy, when to rebalance, how to time the market, which stocks are about to break out. This is what Burton Malkiel called the money machine in his book A Random Walk Down Wall Street, first published in 1973. Malkiel, an economics professor at Princeton, laid out the evidence that stock prices move randomly in the short term. Nobody can consistently predict them. Not analysts, not fund managers, not the financial media pundits who appear on television every night with confident predictions that age about as well as milk left in the sun. The future is unknowable. The market incorporates all available information into current prices. When new information arrives, prices adjust. You cannot outguess that process consistently. You can only participate in it. The entire active management industry depends on the illusion that someone out there knows something you do not. Sometimes that is true. Insiders know things. Professionals with deep research teams might know things, but they cannot trade on that knowledge without moving prices. And by the time you hear about it, the opportunity is gone. The financial news cycle is particularly insidious here. Every day, some analyst upgrades a stock, and another downgrades it. Every day, some network runs segments explaining why the market went up or down. The explanations are almost always nonsense, invented after the fact to sound authoritative. The market went down because investors worried about inflation, or the market went up despite concerns about inflation. Who are these investors? What are their concerns? How do we know inflation was the reason? We do not. The market is a complex system with millions of participants making decisions for millions of reasons. But journalists need to write something, and anchors need to say something. So they invent narratives. And you, the individual investor, sit there, absorbing this information, thinking you need to act on it. You do not. You need to do the opposite of what feels natural. You need to tune it all out. Risk is the great unspoken variable in all of this. I said earlier that risk is not volatility. Let me explain what I mean. The financial industry has convinced everyone that risk equals standard deviation. That risk is measured by how much a stock's price fluctuates. This is convenient for the industry because it produces neat mathematical models and allows them to print pretty charts showing risk-adjusted returns. But it is wrong. Volatility is temporary. If you own a diversified portfolio and the market drops 20%, your portfolio drops 20% on paper. If you do not sell, you have lost nothing except the opportunity to buy more at lower prices. Real risk is permanent loss. If you invest your life savings in a single company, and that company goes bankrupt, your money is gone forever. That is risk. If you invest in a fraudulent scheme, and the perpetrator flees to a country without extradition, that is risk. If you need your money in 5 years for a down payment, and you invest it all in stocks, which dropped 40% in year 4, that is risk. Risk is not about price movement. Risk is about not being able to accomplish your financial goals when you need to. Understanding risk this way changes everything. It means the safest portfolio is not necessarily the one with the lowest volatility. It is the one that aligns with your time horizon, your needs, your psychological tolerance for drawdowns. If you are 25 and have 40 years until retirement, you can afford tremendous volatility in exchange for higher expected returns. If you are 60 and need your money in 5 years, you cannot. The financial industry often treats risk as one size fits all, because it is easier to sell products that way. But your risk is personal. It is tied to your life, your goals, your fears. Nobody else can define it for you. Howard Marks, the billionaire investor who co-founded Oak Tree Capital, wrote memos to his clients for decades. He eventually collected them into books, like The Most Important Thing. One of his key insights is that risk is invisible. You cannot look at a past return stream and know how much risk was taken. The fact that an investment went up does not mean it was safe. It might have been extraordinarily risky and simply got lucky. The fact that an investment went down does not mean it was risky. It might have been safe and just experienced temporary bad luck. Risk and outcome are related, but not identical. You can make a low-risk bet and lose. You can make a high-risk bet and win. The connection only becomes clear over many trials. This is why getting rich and staying rich are two different skills. Getting rich requires taking risk, sometimes lots of it. Staying rich requires controlling risk, sometimes obsessively. Your worst enemy in investing is not the market. It is not the economy. It is not Wall Street. It is not the Federal Reserve, or Congress, or whatever boogeyman the financial media is blaming today. Your worst enemy is the person looking back at you in the mirror. You are the one who panic sells during crashes. You are the one who buys at the top because everyone else is buying. You are the one who checks your portfolio 8 times a day and cannot sleep when it goes down. You are the one who cannot distinguish between real risk and temporary volatility. The entire behavioral finance field exists because economists finally realized that humans are not rational. We are emotional, biased, tribal, and prone to systematic errors in judgment. Daniel Kahneman won the Nobel Prize in Economics in 2002 for proving this, along with his colleague Amos Tversky. Their work showed that humans have 2 thinking systems. System 1 is fast, intuitive, emotional. System 2 is slow, deliberate, rational. Most of our decisions happen in System 1. We use System 2 only when we force ourselves to. Investing requires System 2, but our System 1 screams at us constantly. It tells us to run when markets crash. It tells us to join the herd when markets are soaring. It tells us that this time is different, that the old rules do not apply, that we should act now or miss out forever. There is a rule that Buffett supposedly quoted: be fearful when others are greedy, and greedy when others are fearful. This is easy to say and nearly impossible to do. When everyone around you is panicking, your nervous system activates the same fight or flight response that helped your ancestors survive on the savannah. When everyone around you is euphoric and making money, your brain releases dopamine that reinforces the behavior. You are biologically wired to do exactly the wrong thing at exactly the wrong time. The entire investment industry knows this. They design products that appeal to your worst instincts. They market funds based on past performance, even though past performance predicts nothing. They invent new exotic investments during bubbles because that is what sells. They prey on your emotions while telling you to control your emotions. It is a con game. But it is a con game you can opt out of. You can build systems that force you to do the right thing. You can automate your investments. You can check your portfolio quarterly instead of daily. You can write down your investment thesis when you buy something, so you remember why you bought it when the price drops. You can keep a journal of your emotional state when making major financial decisions, so you see your own patterns. You can do all of this, but you probably will not, because doing all of this requires overcoming millions of years of evolutionary programming. Most people cannot do it. That is why index funds work. Not just because they are diversified and low cost, but because they require almost nothing from you. You set them up and you walk away. You remove yourself from the equation. You let the system work without your interference. Never make a major financial decision after a major life event. This rule sounds so simple. It is anything but. Major life events are exactly when we feel we need to make changes. You get divorced, and suddenly you want to restructure your entire financial life. You lose a parent, and you inherit money, and you feel you must do something meaningful with it. You have a child, and you start panicking about college funds and life insurance and estate planning. All of these impulses feel rational in the moment. They feel like responsible adult behavior, but they are contaminated by emotion. You are not thinking clearly when your world has been upended. You are in crisis mode. Your brain is operating from System 1, the fast emotional system, not the slow rational one. The decisions you make in that state will reflect your emotional state, not your long-term interests. The best advice I ever heard was to create a waiting period. When something major happens, do nothing for 30 days, or 60, or 90. Let the emotions settle. Let the crisis pass. Then make decisions from a place of clarity rather than reactivity. You will not miss any opportunities. The market will still be there. The financial products will still be available. The urgency you feel is manufactured by your own stress, not by external reality. Let us talk about what wealth actually looks like. The Millionaire Next Door, published in 1996 by Thomas Stanley and William Danko, demolished every assumption Americans had about rich people. The researchers studied millionaires for decades. They expected to find people driving luxury cars, wearing designer clothes, living in mansions. Instead, they found something completely different. Most millionaires in America are first generation. Most live well below their means. Most have never spent more than $41,000 on a car. Most have lived in the same house for over 20 years. Most are married and have never been divorced. Most run boring businesses: scrap metal, pavement contracting, mobile home parks, auctioneering. Nobody writes movies about scrap metal magnates. Nobody puts pavement contractors on the cover of Forbes. But those are the actual millionaires. The people who look rich are often the ones with the least wealth. They are high-income, low-net-worth individuals. They make $500,000 a year and spend $500,000 a year. They have the fancy house, the leased luxury car, the country club membership. They also have zero financial independence. One job loss, one divorce, one health crisis, and the whole thing collapses. The actual millionaires are the ones driving 10-year-old Toyotas and living in modest houses they bought decades ago. They are the ones who could not care less about signaling their status through consumption. They figured out that wealth is what you do not see. Wealth is the money you did not spend. Wealth is the car you did not buy. Wealth is the house you did not upgrade. Wealth is accumulation, not consumption. And the only way to accumulate is to live below your means for a very long time. Stanley and Danko identified what they called the prodigious accumulator of wealth, or PAW. These are people whose net worth is at least double what would be expected given their income and age. The formula is simple. Multiply your age by your pre-tax annual household income from all sources except inheritances, then divide by 10. That is your expected net worth. If you are 50 years old, making $200,000 a year, your expected net worth is $1 million. If your actual net worth is $2 million or more, you are a PAW. If it is $500,000 or less, you are an underaccumulator of wealth, or UAW. Most high-income professionals are UAWs. They make a lot and spend a lot. They confuse income with wealth. But income is a flow variable. Wealth is a stock variable. You can have high income and zero wealth. You can have modest income and substantial wealth. The math is simple, but the behavior is hard. Nobody ever got rich by spending money, yet millions of Americans pretend otherwise. They see wealthy people and try to look like them. They have the equation backwards. Wealthy people look wealthy only after they have already become wealthy. They do not look wealthy while they are building wealth. They look like they are making sacrifices. They look like they are missing out. They look like they cannot afford the things their neighbors can afford, because in the moment, they cannot. They are paying a different price, the price of delayed gratification, the price of future freedom. Speaking of houses, let me address one of the most persistent financial myths in America. Your house is not an investment. It is a place to live. This will outrage anyone who bought a house in the 1970s and saw it appreciate 10 times. But that was a specific historical moment, not a universal truth. Houses require maintenance, property taxes, insurance, and transaction costs. They tie up enormous amounts of capital that could be invested in productive assets. They concentrate your net worth in a single illiquid asset tied to a single geographic location. They are not diversified. They are not liquid. They are not without risk. This does not mean you should not own a house. Homeownership has non-financial benefits that matter. It provides stability, community, a sense of accomplishment. But do not confuse those benefits with investment returns. If you want an investment, buy stocks, or bonds, or real estate investment trusts, or a small business. If you want a place to live, buy a house. Just understand that it is a consumption good, not a wealth-building strategy. The mortgage interest deduction does not make it an investment. It makes it a government-subsidized consumption good. The fact that your house might appreciate does not make it an investment. Beanie Babies appreciated for a while too. Appreciation alone does not make something an investment. An investment is something you buy because it generates returns. A house you live in generates zero cash flow. It consumes cash flow. You are the one paying for everything. That is the opposite of an investment. The true measure of wealth is not money, it is time. This is the central insight of Your Money or Your Life, the book Vicki Robin and Joe Dominguez published in 1992. Dominguez was an interesting character. He was born in Harlem, never finished college, and worked on Wall Street as a technical analyst. He made good money, but hated the culture. In his late 20s, he calculated exactly how much money he would need to never work again. He tracked every penny he spent. He invested conservatively. He reached financial independence at age 31. Then, he spent the rest of his life teaching others how to do the same. The book argues that we trade our life energy for money. Every dollar you spend represents time you worked. When you buy something, you are not just spending dollars. you are spending hours of your one wild and precious life. The question is not whether you can afford something. The question is whether that thing is worth the hours of your life it cost. Framed this way, many purchases reveal themselves as absurd. That $5 coffee, 15 minutes of work. That new car you financed, 2 years of your life. That bigger house you cannot really afford, a decade. We do not think this way naturally, but the math works. Time is the only resource you cannot get back. Money can be earned again. Time is finite. Every hour you spend working is an hour you cannot spend with your children, or hiking in the mountains, or reading great books, or doing whatever makes your life meaningful. Financial independence means having enough saved that work becomes optional. Not that you stop working, but that you choose to work rather than having to work. That choice is the ultimate luxury. It is more valuable than any car, any house, any possession. Ramit Sethi wrote, "I Will Teach You to Be Rich" in 2009, and he approached this topic from a completely different angle. He argued that you should not try to cut spending on the things you love. You should cut spending mercilessly on the things you do not care about, and spend extravagantly on the things you do. Most people do the opposite. They pinch pennies on daily pleasures like coffee or lunch with friends, then spend thousands on things they barely notice. They negotiate for 20 minutes to save $50 on a hotel room, then spend $500 on a designer handbag they will use twice. Sethi's point was that frugality without purpose is just deprivation. The goal is not to spend as little as possible. The goal is to spend on what matters to you and to save enough to have options. His book walks readers through automating their finances, negotiating their salary, investing in low-cost funds, and building a system that runs itself. He understood that willpower is a limited resource. You cannot rely on willpower every month to save money. You have to set up automatic transfers and automatic investments so the right thing happens without your intervention. You have one chance to make a good decision. Use that chance to set up the system, then let the system run. The best investment you can make is not in stocks or bonds or real estate. It is in yourself. Your earning power is your largest asset by far, especially early in your career. A 22-year-old has almost no financial capital, but they have 40 years of earning potential ahead of them. If they can increase their income by $10,000 a year through skills, education, or career moves, that is worth more than any investment they could make with their small starting capital. The return on investment for a degree, a certification, a skill, a career pivot can be astronomical. Not all education is worth it. Some degrees have negative returns. Some certifications are worthless. The analysis has to be honest. But writing off all self-investment because some self-investments are bad is like writing off all stocks because some stocks go bankrupt. The math matters. A course that costs $5,000 and leads to a $10,000 salary increase has paid for itself in 6 months. After that, it generates returns forever. Your brain is the only asset that compounds at the rate you choose to compound it. $1 invested in the stock market returns about 7 to 10% annually over long periods. $1 invested in the right skill or credential can return 1,000%. The downside is capped at what you spend. The upside is uncapped. You will carry your skills and knowledge with you for the rest of your life. No market crash can take them away. No recession can devalue them. They are yours. Eventually, if you follow these rules, you may reach what people call financial independence. The definition varies. Some people call it saving 25 times your annual expenses. Some people call it the point where work becomes optional. Some people call it never having to worry about money again. The specific number matters less than the underlying reality. Financial independence is not about luxury. It is not about private jets and beach houses and eating at Michelin-starred restaurants every night. It is about options. The option to quit a toxic job. The option to take time off to care for a sick parent. The option to start a business without worrying about failure. The option to say no. The option to wake up on a Tuesday morning and ask yourself what you want to do today, rather than what you have to do. Most people do not have this option. They are trapped in cycles of earning and spending, working and consuming. They have no buffer. One unexpected expense can spiral into debt. One job loss can destroy everything. Financial independence is freedom from that fear. It is the knowledge that you will be okay no matter what happens. That security is worth more than any luxury. What do you do after you have enough? This is the question that most finance books do not address. They stop at accumulation, but accumulation is only half the story. Eventually, you have to ask yourself what the money is for. Some people never ask. They accumulate endlessly, dying with millions in the bank, having never used any of it for anything beyond making more of it. This is the dragon sickness that Tolkien wrote about. Hoarding wealth creates no value. It serves no purpose. Money is a tool. A tool you never use is not a tool at all. It is just an object taking up space. The final rule of wealth is to give back. Not because you should, not because anyone is watching, but because hoarding money is psychologically corrosive. It turns you inward. It makes you small. Giving expands you. It connects you to something larger than yourself. It reminds you that money is a means, not an end. The act of giving is also the act of letting go. It signals that you have enough. It signals that you are not defined by your net worth. The psychological benefit of giving often exceeds the psychological benefit of receiving. This is one of the most replicated findings in happiness research. Spending money on others makes you happier than spending money on yourself. The irony is that the more you give away, the wealthier you feel. Not because your net worth changes, but because your relationship to money changes. Money amplifies who you already are. I mentioned this earlier, but it bears repeating because it is the most important truth about wealth. If you are generous, money makes you more generous. If you are anxious, money makes you more anxious. If you are petty, money makes you more petty. If you are kind, money makes you more kind. Money does not change your character. It reveals it. The poor jerk who suddenly becomes rich is not suddenly a jerk. He was always a jerk. He just did not have the money to show it. The generous person who becomes rich does not suddenly become generous. They always were. Money gives you the resources to act on your existing impulses. This is why lottery winners so often end up miserable. They were the same people after winning that they were before. The money just let them act on all their impulses, good and bad, at a much larger scale. If your relationship with money is unhealthy when you are broke, it will be unhealthy when you are rich. The number on your bank account does not fix your psychology. It magnifies it. The goal is not to die with the most toys. I have heard people talk about building generational wealth as if that is the ultimate purpose of money. It is not. Leaving something for your children is fine. Leaving enough that they never have to work is not fine. It deprives them of the struggle that builds character. Warren Buffett said he wanted to leave his children enough money to do anything, but not enough to do nothing. That is wisdom. Andrew Carnegie wrote an essay called The Gospel of Wealth in 1889, arguing that dying rich was a disgrace. He believed that the wealthy had an obligation to distribute their fortunes for public benefit before death. He gave away 90% of his wealth while alive. His legacy is not his bank account. It is thousands of libraries, universities, and cultural institutions that still exist today. He understood that money is not wealth. It is potential. Realized potential is value. Unrecognized potential is waste. When you strip away all the jargon, all the products, all the complexity, the rules are remarkably consistent across all these books. Spend less than you earn. Pay yourself first. Invest in low-cost, diversified funds. Wait, do not try to outsmart the market. Do not let emotions drive your decisions. Understand what you actually need versus what you think you want. Build systems that force good behavior. Give back. Be patient. Start early. Keep going. The books disagree on details. Some tell you to cut expenses to the bone, others tell you to focus on increasing income instead. Some emphasize real estate, others prefer stocks. Some advocate for entrepreneurship, others recommend steady employment. But underneath the different emphases, the core principles are identical. Babylonian merchants understood them 5,000 years ago. Benjamin Graham articulated them for the modern era in 1949. Every subsequent author has essentially been remixing the same insights for new audiences. Why do we need so many books saying the same thing? Because we do not follow the advice. We know what to do. We have always known. The challenge is not knowledge. The challenge is behavior. It is doing the boring thing repeatedly when the boring thing shows no immediate reward. It is resisting the temptation of shortcuts when shortcuts are advertised everywhere. It is staying the course when everyone around you is panicking or celebrating. The rules are easy to state and hard to follow. Every generation needs to hear them again. Every generation thinks their situation is different. It is not. The currency changes, the specific investments change, the tax code changes, the technology changes. But human nature does not change. Our brains still operate on software written on the African savanna. We still respond to fear and greed the same way our ancestors did. We still make the same mistakes for the same reasons. We still need the same reminders. That is why these books sell. Not because they contain secrets, because they contain truths we already know, but cannot quite hold on to. They are mirrors reflecting back what we need to see. If you stacked every personal finance book ever written, the pile would reach the moon. But the actual rules that work could fit on a single page. They would look something like this. Save at least 10% of everything you earn. Put that money in low-cost, diversified investments. Never touch it. Live on the rest. Avoid debt that does not build assets. Build an emergency fund that covers 6 months of expenses. Never make major financial decisions during emotional times. Understand that time is your greatest asset, not money. Invest in yourself continuously. Give back generously. Everything else is elaboration, marketing, or noise. You can read 1,000 books. You can listen to 100 podcasts. You can subscribe to every financial newsletter. You will eventually arrive at the same place. The rules have not changed in 5,000 years. Only the currency has.